Purchasing a single share of stock is the direct acquisition of legal, fractional ownership in a functioning business. This certificate represents legally binding rights. Holding these shares entitles you to a claim on the company's assets, a portion of the earnings through dividends, and voting power in corporate governance. Managing these benefits requires a specific understanding of the structural and market risks inherent to the asset class. Corporate ownership operates on a residual claim hierarchy. Creditors and bondholders are paid first during liquidation. Preferred stock occupies the middle ground with a fixed dividend. Common stock sits on the bottom tier, absorbing maximum risk but retaining voting rights and uncapped upside potential. Your position in this capital stack depends on whether your objective is growth and voting influence or the security of fixed income. Profitable companies distribute excess cash to shareholders through dividends on a rigid timeline: declaration, ex-dividend, record, and payment. The ex-dividend date is the absolute cutoff point. Buy shares on or after this morning, the previous owner keeps the cash payout, and you immediately absorb the stock's corresponding price drop. Mastering this timing window is the primary mechanism for capturing dividend yield in the equity markets. A single stock share price provides no information regarding total scale. Risk is determined by market capitalization, the share price multiplied by all outstanding shares. Large cap companies are valued above $10 billion, providing portfolio stability and minimal liquidity risk. Conversely, small cap stocks offer the steepest growth trajectories, but expose capital to extreme business volatility and rapid market swings. Capitalization tiers dictate the severity of price swings, making market cap the primary tool for sizing and managing portfolio risk. Purchasing traditional equities requires paying the full, unleveraged price for corporate ownership. This creates a high capital burden that can heavily restrict wealth generation. Active participants bypass this limitation by using futures contracts. This allows exposure to equity price movements without committing the full capital required to own shares. A mastery of these equity market mechanics is required before advancing to high-leverage derivatives. Basic equity ownership is the starting point. Profitable trading requires applying these mechanics to the leverage found in the futures market. Apply these equity mechanics to modern future strategies by visiting thefranksreport.com for your copy of the Funded Micro.